Let's talk about foreclosure. It's a word that usually brings to mind one thing, a total financial loss. But what if that wasn't always the end of the story? Today, we're diving into a surprising financial silver lining that can pop up after a foreclosure, something called surplus funds. Let's find out how it all works.
It's the big question, right? When a home is lost, does all the equity, all that value, just vanish? It's a really painful assumption that most of us make. But the good news? That assumption is very often wrong.
In so many cases, the answer is a huge no. Right now, county governments across the country are holding on to millions and millions of dollars from foreclosure sales. And here's the thing. It's not their money. It legally belongs to the very people who lost their homes. It's this hidden financial resource that most people have no idea even exists.
So what is this money exactly? Where does it come from? Let's break down what we're actually talking about here.
The idea is actually pretty simple. When a property is foreclosed on, it gets sold at a public auction. Now, if that sale brings in more money than what was owed on it, to cover the mortgage, taxes, and fees, that extra chunk of cash left over is called surplus funds. And here's the most important part. That money doesn't belong to the bank or the county. It belongs to the former homeowner.
To really get a handle on this, it helps to see exactly how it all happens. So let's walk through the sequence of events that actually creates these funds in the first place.
Okay, so it all kicks off when a foreclosure notice is filed. Then the property goes up for public auction. The money from that sale is first used to pay off everything that's owed, the mortgage, any tax liens, all the legal costs. But the crucial step is what happens right after that. If there's anything left over after all those debts are paid off, that money becomes surplus funds. The county doesn't keep it, they just hold it in an account, waiting for the rightful owner to come and file a claim.
So, if you're thinking there might be money out there waiting for you, how do you actually get it back? This brings us to the practical stuff, the path to recovery.
Well, the process starts by proving you're who you say you are. This usually means tracking down a few key documents, a copy of that foreclosure auction notice, the original deed with your name on it, and, a standard government photo ID. This is all about making a crystal clear link between you and that property. Now, here's something really interesting. This right to the money doesn't just disappear if the original homeowner has passed away. If you're an heir or the executor of an estate, you can still file a claim. You'll just need a bit more paperwork, like a death certificate and legal documents like a will or probate order to prove your relationship and that you have the legal right to claim it.
Getting the documents together is one thing, but actually navigating the whole system, that's another story. Let's take a look at what the timeline for a claim really looks like.
It's really important to be realistic here. This is not a fast process. You'll start with a few weeks of just getting all your documents in order, then you submit them to the court. Then comes the longest part, the administrative review, which can easily take 1 to 2 months. After that, there are legal notice periods before you get to the final disbursement. All told, you're looking at a minimum of 3 to 4 months, and honestly, complicated cases can take even longer. So yeah, patience is definitely key.
Let's be real. Seeing that timeline and the list of legal hoops to jump through can feel pretty overwhelming. The paperwork, the court filings, all the follow-up, it's a lot to deal with, especially if this isn't your world. That's exactly why specialized recovery services exist.
For example, the source material for this whole explainer comes from a recovery service called Gabel Recovery Group. Organizations like this one specialize in one thing, helping former homeowners and their families get through the maze of the recovery process. A professional recovery service basically takes the entire burden right off your shoulders. They handle all the document management, they deal with the court filings and all the back and forth communication, and they make sure that once the money is approved, it gets to you securely and directly. They pretty much navigate the legal maze so you don't have to.
And that, of course, leads to the big question. For someone who has just been through a foreclosure, the last thing they probably have is extra money for legal fees. So what's the catch?
The answer, and I'm quoting directly from the source material here, is simple. Nope, never. They make it clear that they cover all the upfront costs for filing and legal work. If they can't recover your money for whatever reason, you owe them absolutely nothing.
So here's the bottom line. It works on what's called a contingency fee. A fee only gets charged if and when they successfully get your money back. This means there is zero financial risk to you, none, which is a massive relief for anyone in this kind of situation.
Okay, we have covered a lot of ground, so let's just boil this all down to the most important things you need to remember.
So if you remember anything from this, let it be these 3 things. First, surplus funds from foreclosures are real. They exist, and the amounts can be huge. Second, there is a clear legal process to claim what is rightfully yours. And third,
You don't have to try and figure this all out on your own. There's expert help available, and often with no upfront cost or financial risk.
And that leaves us with one final, really important question. After everything we've gone over today, it's worth asking, could you, or maybe a family member or a friend who's been through a foreclosure, have unclaimed funds just sitting there waiting for them right now? It's definitely something worth looking into.